Now in accounts for standard 12, we'll be starting part 1. In that lesson number 1, introduction to partnership. Okay, so today we are going to see that is theory portion for this particular chapter. Now in introduction part, that is the partnership form is emerged from capital and managerial limitations of sole proprietorship firm. See, this can be asked in your section B, that is answer in one sentence, that how partnership form emerged, okay, or how partnership form came into existence. So because of the limitations of capital and managerial limitations in sole proprietorship, see, sole proprietorship already you have studied in 11th standard. Sole proprietorship where there is only one owner, okay, जब एक ही businessman होता है, that is only one person is handling the whole and soul of the business, that is the whole business is being handled by one person. In that case there are limitations of capital and managerial limitation, that is capital. One person does not have enough fund to invest in the business, or one person is not able to handle the whole business. So managerial and capital functions are there, okay, which are the limitations of sole proprietorship. And because of this limitation, what came into existence? So partnership form came into existence, okay, where more than one person can indulge and they can invest the money and they can give their performance, that is they can act for the business, they can work for the business. So each and every person will be having different managerial capacity, okay. So वो अपने तरीके से अलग अलग काम करेंगे, प्लस अपना अपना पैसा भी इन्वेस्ट करेंगे. So because of this, partnership form came into existence. That is, in sole proprietorship there was only one person, and one person's capital and managerial capability was not enough for the business. So partnership form came into existence. Fine. Following are the reasons for the emergence of partnership firm. If they are asking you for 1 mark, that state the reasons for the emergence of partnership firm. So again the same thing, that is capital and managerial, but they have written in that is detail. That is, an individual has sufficient fund but does not have required skill. When a person is having money but he does not have the skill, उसके पास काम करने का तरीका या knowledge नहीं है, so in that case he is having sufficient funds but he is not having the proper skill. So this might be the one reason. An individual has required skill but does not have sufficient fund. He have proper knowledge, he is having all the skills, उसको market conditions के बारे में पता है, कैसे business run करता है वो भी पता है, but he is not having the sufficient fund, he is not having the money. So that is the second reason. Then to distribute that business risk, he does not want to take the responsibility of the business whole and soul on him. So he want to distribute the risk, that is अगर future में कुछ होता है तो वो अकेला ही होगा जिसको सब कुछ bear करना पड़ेगा losses. So if in that case he want to distribute the business risk among 2 or 3 person, then also he can go for partnership firm. So these are the reasons for the emergence of partnership firm. Further see, more than one person, additional capital, skill and managerial ability are required to run a business at a large level. See, if you want to start your business on large level, that is on big level, okay, then one person is not enough. You need more capital, you need more skill, you need more managerial ability. So in that cases also you have to go for partnership. In these circumstances, more than one person gather and become the supplement to each other and commence a business. Commence means they start a business. Fine. This form of business organization means a partnership firm. Next point number 2, that is, let us see meaning and definition of partnership. In this, according to section 4 of Indian Partnership Act 1932. So first of all, remember that the partnership definition is there in the Indian Partnership Act in the year that is 1932. Sometimes they are also asking in MCQ that Indian Partnership Act came into existence in which year. So it was 1932. Or the definition of partnership in Indian Partnership Act is given under which section. So it is given under section 4. So both the things remember for MCQ. Fine. So it is defined that partnership is the relationship between the person who have agreed to share the profit of the business carried on by all or any one of them acting for all. Again, this definition you have already learned in 11th standard in BA. Fine. That is, partnership is a relationship between the persons. First only remember till here that partnership is one type of relationship between the persons. Now, who have agreed to share the profit of the business. Second part, okay. So the first part you have to remember that partnership is the relationship between the person. Second part, they have agreed to share the profit of the business. Third part, carried on by all or any one of them acting for all. One can be the active partner and remaining can be the other type of partners. That is, one partner is very active and he is doing the whole and sole business for on behalf of all the other partners. So either one partner is acting, all might be acting, all are working actively. Fine. So that depends upon the partnership deed. That is how they are dealing, how they are finding out, okay, what are the circumstances which are there among all. So it might be carried on by all or any one of them acting for all. The person who enters into such relationship are individually called partners. So if they are asking you for 1 mark, that what do you mean by partners? So the partners, the person who enter into the relationship as are individually called partners, and collectively they are called as a firm. If they are asking you what do you mean by firm or what do you mean by partner, then you have to write down this answer. That is, the person who are entering into relationship individually, one person is known as partner and collectively all the persons are known as, that is, firm. Okay, so this you have to remember. From the above definition, it can be said that 2 or more persons who are complement to undertake a contract to earn profit from the legal business, the business is termed as partnership. जब 2 या 2 से ज़्यादा लोग मिलते हैं, साथ आते हैं कोई कॉन्ट्रैक्ट में, that is why they are coming together. They are coming together to earn profit from a legal business. Okay, तो वो अगर पैसा कमाने के लिए बट कोई लीगल बिजनेस शुरू करते हैं, तो अंडर दैट सर्कमस्टेंसेज इट इज़ ट्रीटेड एज partnership. The business run collectively in partnership by 2 or more person is known as partnership. Okay, now next point is, that is characteristics of partnership. The first point is, that is creation by contract. Okay, there is a contract among all the persons which is known as partnership. So see, partnership emerges through agreement. Partnership agreement can be written or oral form. Okay, so when you are entering into partnership, there is a creation by contract and there can be either written contract or oral form. Okay, or that is orally the contract is being taking place between 2 person or more than 2 person, or there can be a written contract, but written form is desirable and advised. Okay, out of this 2 form, written or oral, a written form is more advisable, because what will be the situation? Orally you cannot claim any person, you cannot take anyone to the court if there are any disputes among the partner. So if you are having a written form of contract among the partners, then if any problem arises in the future, then for that dispute you can easily go to the court if there is a written contract. Fine. Next, profit objective. As in the definition itself of partnership, there is that is, the persons are coming into relationship, 2 or more persons, and they are coming into contract. They have agreed to share the profit of the business. Okay, so when they are coming into relationship, what they are agreeing to share the profit. So the second objective that is in partnership, that is profit objective. Partnership forms to earn and distribute profit. Okay, why they are coming into existence? That is to earn profit, and whatever profit is being earned, it is to be distributed among all the partners. The distribution of profit or loss is done among the partners in their predetermined proportion. Predetermined means it is decided prior. Okay, that is when they are coming into agreement for the partnership act. Okay, for the partnership firm, at that time only they will decide that they will distribute the profit among so and so ratio, that is predetermined proportion. As per Partnership Act, profit or loss is distributed in equal proportion if no provision is made in the contract. If they have not made any kind of provision that they will distribute the profit in the ratio 2:3 or 4:5 or 2:1, so under that circumstances, when nothing has been decided among the partners, in that circumstances it will be distributed among them, that is in equal proportion, that is 1:1. Okay, if there are 2 partners, it will be 1:1. If there are 3 partners, it will be 1:1:1. Fine. So when nothing has been decided among the partners that how the profit will be distributed, then under that circumstances it will be distributed equally. Then moving on to the third characteristics. So see, that is, it is a legal business. Again, in the definition itself it is mentioned that they are coming together, they are coming into relationship to share the profit for some legal business. Okay, so the third characteristics is, that is, there should be any legal business going on. So partnership firm is formed to do a legal business. Next, agent of each other. See, each partner for each other, they are agent, okay, for one another. The business of partnership firm is run by all the partners or any one of them for all or more than one partner. Thus, each partner is an agent of each other. Next, number of partners. according to section 464, again please remember the section that is for Companies Act, okay, not partnership, but it is Companies Act, and the Companies Act is 2013, okay. In this year it was being formed. So empowers the government to prescribe maximum number of partners in a firm subject to maximum of 100. So if they are talking about company and in that company there is a partnership, the maximum numbers can be 100. Fine. The government has prescribed maximum number of partners in a firm. If it is not a company and if it is a small firm, that under that case it will be to be 50 by rule number 10 of the Companies Rule 2014. Okay. So according to 2000 Act, there is 100, and according to Miscellaneous Companies Act, that is in the year 2014, according to that there will be 50. Next is unlimited liability. Unlimited liability you have already studied in BA, that is unlimited liability. In each and every business in India there is unlimited liability. It means if there are some losses or dues are to be paid to the creditors, under that circumstances, if a person is not having enough money, then all his property will be sold off, and from that property, personal property also included in this. So out of that, the personal liabilities will be paid off. First the business assets will be sold off, that is business property will be sold off. If that is not enough to pay the liabilities, then all the personal assets also will be coming into consideration to sold off to pay this liability. That is known as unlimited liability. As per Partnership Act, partners are responsible to pay the business obligation, that is your dues. Okay, अगर किसी को पैसे देने बाकी है तो you have to pay it from their personal property when the firm does not have sufficient asset. If you do not have business assets, okay, in that case you have to go to your personal property. That is, business properties are not there, then you have to move on to personal property to pay the dues of the business liability of the business liability. Every partner individually and collectively is responsible. So each and every partner is individually and collectively responsible for the partnership firm. Therefore, the liability of each partner is unlimited. Next, ownership and management of the firm. Partners are owners of the business and they do the management of the business. So the management of the business is done either by all partners. See, all partners will be having ownership, but sometimes there is certain cases that only one partner is active, so he is having the management. Okay, others all are sleeping partner or dormant partner or any other type of partner. Okay, but one partner is that is active partner, so management will be done by that one partner. That but for that particular business, all the partners will be having the ownership. Clear? So partners are owner of business and they do the management of business. The management of business is done either by all the partners or by one or by more than one. There can be one active partner, there can be more than one active partners also. Okay. Next, that is partnership deed. See, in short, remember what do you mean by partnership deed? It is nothing but the return contract. Okay, that is known as partnership deed. When the partners are having a return contract among themselves, that is known as partnership deed. Fine. The emergence of partnership from the agreement, that is, the partnership is emerging from the agreement. Either it can be oral or written, but written is more advisable, and that return contract is known as partnership deed. Fine. Partners undertake agreement within the provision of Partnership Act. Partnership deed acceptable to all the partner is prepared at the time of commencement of the partnership firm. Commencement means when they are starting the business. The partnership agreement can be written or oral. A written agreement of the partnership is known as partnership deed. Please remember this. What do you mean by partnership deed? So a written agreement among the partners for partnership is known as partnership deed. A written partnership deed is desirable and advisable so that the solution, see, if they are asking you why a written partnership deed or why partnership deed is desirable, so this is your answer. Okay, that is, a written partnership deed is desirable or advisable so that the solution of any misunderstanding or dispute in future can be obtained on the basis of the provision of partnership deed. So you have to write down this much. If they are asking you that why partnership deed is to be prepared or why it is advisable, so under that circumstances you will write down this answer. That is, in case if there is any misunderstanding or dispute coming among the partners in future. So that can be solved on the basis of this provisions of partnership deed. The partnership deed is an administrative constitution of the partnership firm where all the provision pertaining to the firm administrations are included. That is, all the details of the partnership firm will be in this particular partnership deed. Generally, the following content is included in the partnership deed. See, first, details of partners. So the information about the partners, that is their name, address and other details of partners is there. Details of firm, that is the details like name and address of the firm are included in this. Type of business, what type of business you are doing, small business, large scale business, or on what type of business, that is either raw material or some other thing, utensils, okay, so some manufacturing work or some selling work. So under what circumstances your partnership business is taking place, so you have to write down the type of business. Commencement of partnership, the information about the commencement date of partnership firm is also covered in the deed. That is, when the business was started, that particular date is to be mentioned in this. Capital, there are few partners, for example there are 3 partners, okay, so what amount of capital, that is the amount invested in the business by each partner, is to be mentioned. For example, partner A brought 1 lakh rupees, partner B brought 2 lakh rupees and partner C brought 4 lakh rupees. So that is the amount of that is how much amount they have invested in the business, that is capital. So you have to mention in this that which partner brought how much particular amount. It is not mandatory. Mandatory means compulsory. It is not mandatory to bring a capital by each partner. See, sometimes there are some persons who are very good at their knowledge and skill. So sometimes they are not bringing anything, but they are bringing their knowledge with them. So it is not compulsory that all the partners should bring certain amount of capital. Fine. Interest on capital. Whether interest on capital is to be paid or not. If yes, then what percentage? These points are to be mentioned in the partnership deed. If no provision is made in partnership deed, then no interest on capital is to be paid to the partner. If in partnership deed, suppose see, all the partners have decided that interest on capital will be paid by the firm to the partners, that is 5%, 10%. So if they have decided that this particular percentage will be paid by the firm to the partners, then the interest on capital is to be calculated. But if they have not decided any percentage, then in that circumstances interest on capital will not be given to the partner. Okay, now another thing, it is also asked in MCQ that interest on capital is expense or income for the firm. Okay, so see, first of all, capital is what? The amount which, suppose I am having a business and I am one of the partners, so the capital means what amount I have invested in that particular business. So on that I will be getting interest. Okay, so for firm, interest on capital is an expense, but for the partner it is an इनकम. ओके, पार्टनर को पैसा मिलेगा, इंटरेस्ट ऑन कैपिटल उसको मिलेगा. कौन देगा? तो फर्म देगा. सो फॉर फर्म इट इज़ एन एक्सपेंस एंड फॉर पार्टनर इट इज़ एन इनकम. फाइन. देन ड्राइंग्स. ओके, capital is the amount which you are investing in the business is known as capital. Drawing, which you are withdrawing from the business. Okay, you are taking the money for your personal use, that is known as drawings. Okay, capital and drawings, this terminologies you have already studied in 11th standard. What maximum amount can be withdrawn by each partner is also mentioned in the partnership deed. That is how much maximum amount, 50,000, 1 lakh you can withdraw. Okay, so what will be the maximum amount a partner can withdraw will be discussed in this partnership deed. Again, interest is to be paid. Okay, at what rate is to be charged on drawing made by the partner during the year is to be mentioned in the partnership. For example, 5%, 10%, 8%, 6%. But if there is no provision in partnership act for the interest on drawing, but if necessary such provision can be included in partnership deed. See, if there is no provision, then no interest on capital, no interest on drawing is to be given. Okay, but if they have mentioned some percentage, then you have to again calculate the interest on drawing. Again, now this interest on drawing is what? For firm and for partner. Fine. See, interest in first of all, drawing. What is drawing? So the partner has withdrawn this amount as a loan from the business for his personal purpose. तो जब drawings उसने लोन के तौर पे फर्म में लिया है, तो फर्म के लिए इंटरेस्ट ऑन ड्राइंग क्या होगा? इट विल बी इनकम. Okay, and partner, for partner it will be expense, because this drawing is one type of loan which he has taken from the business for his personal use. So on that, the partner has to pay this interest on drawing to the firm. So for firm it is income, and for partner it is an expense. Okay, so these MCQs are being asked. Okay, so please remember that what is interest on drawing for firm, what is interest on drawing for partner, same way this also. Fine. Moving on to next topic, that is next point, distribution of profit and loss. Again, it is already decided that if there is certain proportion among the partners, for example they have given 2:3, 3:2, 2:1, okay, so according to that it will be given, the profit will be distributed according to this proportion. But if nothing is mentioned, then the amount will be distributed among the partners, that is equally. Okay, so when there is no provision, it will be distributed in equal proportion. In which proportion profit or loss of business will be distributed among the partner is provided in the partnership deed. If no provision is made in partnership deed, as per the Partnership Act, profit or loss distributed in equal proportion. Fine. Moving on to next topic, that is salary, bonus, commission and remuneration. Remuneration is nothing but that is salary only, one type of salary which the partner is receiving for the work done by him. There is no provision in Partnership Act for the payment of salary, bonus, commission and remuneration to the partner. If any partner takes active participation in the management of the partnership firm, a provision is made in the partnership deed for the payment of salary, bonus, commission and remuneration to the partner. See, likewise there is no provision, but if there is some partner who is an active partner, okay, then under that circumstances he will be getting salary, bonus, commission and remuneration for his extra work. Fine. Next, interest on loan provided by the partner to firm. See, interest on loan provided by partner to firm. Partner ने firm को loan दिया है. Partner is giving money to the firm on loan. Okay, so the rate of interest is to be mentioned in the partnership deed when any partner has lended a loan to the firm. If no provision is made in the partnership deed as per the Partnership Act, 6% per annum. Per PA means per annum, yearly. Interest will be paid on the loan given by the partners to the firm. Interest on partners loan is treated as an expense of the business. Okay, interest on partners loan is treated as an expense for the business, that is for the firm. Okay, because here the partner is giving the loan to the firm, so for this is loan for the firm, so interest will be treated as an expense. Thus it is debited to P&L account. Where it is going, so it is debited to P&L account. And this interest on partner's loan, for partner it is income, but for the firm it is a expense. And how much percentage you have to remember, if nothing is mentioned, it is to be 6%. See here what they have told you, if nothing is mentioned, so do not calculate interest on capital. Again here nothing is mentioned, do not calculate interest on drawing. But here in interest on loan provided by the partner, if nothing is mentioned, then you have to take 6% per annum. Clear? Next is goodwill. See, what do you mean by goodwill first of all? Okay, goodwill is nothing but that is the reputation of the firm calculated in terms of money. Okay, that is goodwill. कंपनी की मार्केट में रेपुटेशन कैसी है, अगर उसको आप इन टर्म्स ऑफ मनी कैलकुलेट करोगे, सो दैट विल बी ट्रीटेड एज गुडविल. फाइन, वी विल बी डिस्कसिंग दिस चैप्टर लेटर ऑन इन डिटेल. Right now, see, the computation to determine the value of goodwill at the time of admission of a new partner and at the time of retirement or death of a partner is also mentioned in the partnership deed. So when you are supposed to calculate the goodwill, when you are admitting a new partner, or when some partner is retiring or dying, under this circumstances you have to calculate the goodwill again. Okay, next is admission and retirement. The provision pertaining to admission of a new partner, that when can a new partner be admitted, or under which circumstances a partner can take a retirement, and how you will deal when some partner is dying. So all these provisions are to be mentioned in the partnership deed, that what will happen if one partner dies, or what will happen if one partner goes, or if you need a more partner, then how, what, under what circumstances you will be adding a new partner. Next, dissolution of a firm. It means closing, okay, shutting down. So under what circumstances you will dissolve the firm, what will be the procedure. So all these points are to be mentioned in the partnership deed. Fine, do not go through this paragraph. Okay, next, provision of Indian Partnership Act 1932 pertaining to accounting treatment in absence of partnership deed. Now, if suppose this partnership deed is not there, under that circumstances, what steps are to be taken? So this is the steps, that is, these points will be applicable if this partnership deed is not prepared. So this is applicable automatically among all the partnership firms, okay, when they are not preparing the partnership deed. Clear? Now see, first point, each partner contributes capital in the firm by mutual agreement. So there is no restriction in the act in this regard. It is not mandatory to bring capital for each partner. See, again, this point is already here, okay, discussed, that all the partners have to bring capital, but it is not compulsory for all the partners to bring it, okay. If the partner wishes, they can bring. If they are not wishing, okay, they have some certain capability or some special characteristic in them, so it is not compulsory for each partner to bring the capital. Next, interest on capital of partner cannot be paid. So here it is given, if nothing is mentioned, provision is not there, so interest on capital is not to be calculated. Then the distribution of profit and loss will remain in equal proportion. So again, this also we have seen that if nothing is given, nothing is discussed about the proportion of profit and loss, then under that circumstances it will be distributed equally among the partners. Next, interest on drawing of the partners cannot be charged. Again, if they have not discussed anything that how much interest on drawing is to be given, then it will not be calculated. Salary, bonus, commission or remuneration cannot be paid to the partner. If nothing is discussed, then no need to pay anything. 6% interest is payable for the loan given by any partner to the firm. So if the percentage is not given, then compulsory you have to take 6%, okay. In case of any reasonable expenses incurred by the partners of the firm, the partner has to right to reimburse it. So reimburse means to pay back, okay. That is, for example, I have bear certain expenses on behalf of the firm, then the firm will pay me that particular money later on, okay. That is, they will reimburse it. Next is a new topic, that is capital account of a partner, okay. A capital account of each partner is prepared in the books of partnership firm to record the individual transactions done by the partners with the partnership firm, okay. An initial capital introduced by the partner and additional capital in any means are recorded at the credit side of the capital account, and transaction which reduces the capital are recorded at the debit side of capital account. So see, first of all, the where you have to record, if there is any addition, then you have to record on credit side of capital account, and if there is any reduction, then you will record on the debit side of capital account. See how, suppose this is your capital account, okay. If there is any addition, you will record here capital, okay, that is additional capital. If there is any reduction, it means you are withdrawing something, okay, so you will be recording this side, that is on the debit side of the capital account. Fine. So this is your debit side, this is your credit side. Now see, next there are two methods to maintain capital account. Again, remember this for 1 mark, okay, answer in one sentence. That is, how many methods are there to maintain capital account? So there are two methods. One is fluctuating capital method and one is fixed capital method, okay. See, what do you mean by fluctuating? See, capital means the money invested, okay. Now fluctuating, so there is increase and decrease in fluctuating, okay. And in fixed, fixed means it is fixed. If it is 1 lakh, it will be 1 lakh only throughout the life of the business. Fluctuating means right now it is 1 lakh, tomorrow it can be 50,000, day after tomorrow it can be 2 lakh, okay. So capital amount changes. So when there is a change in capital account, it is known as fluctuating. When there is a fixed capital account, it means there is no fluctuation in the amount of capital. It is fixed, means it is fixed, okay. Now what you have to remember, in fluctuating, there we are preparing only one capital account, okay. So see, in fluctuating, okay, one account is prepared. Right now remember only this. Whereas in fixed method, okay, there are to be prepared two account. One is fixed capital account and one is current capital account, okay. Right now remember only this much, that is, in fluctuation only one account is prepared. Only one account means one capital account is to be prepared, okay. One capital account is to be prepared. Whereas in fixed, you have to prepare fixed capital account and you have to prepare current capital account. So see, this is your fluctuating capital, okay. This is your capital account. Okay, see, by opening balance, okay, that is your credit balance of capital account. And if any any other transactions are coming, that is interest on capital, salary, bonus, commission, okay, all are to be recorded here. Any drawings are there, interest on drawing is there, loss is there, so it is to be recorded here. As profit will be coming here, loss will be coming here. Okay, you will come to know when you will be preparing, you will be doing the sums. Okay, so this is just a brief introduction. So this is your partner's capital account. Fine. Next is fixed. See, in fixed, how many types are there? Two are there. Okay, partner's capital account, that is partner's fixed capital account, and another one is partner's current account. Okay, so here there will be two separate accounts. See, in fixed capital account, this is your fixed capital account. Okay, so there is only capital is to be recorded in this particular, or any asset if you are bringing furniture or anything. Okay, so then that you have to record here. Okay, nothing else. Nothing else means, for example, see, there is interest on capital, salary, bonus, commission, remuneration. So these all items won't come here in fixed capital. These all items will go to current account. That is the another account which you are preparing. See here, interest on capital, salary, bonus, commission, remuneration, divisible profit, this side divisible loss, interest on drawing, okay, interest on current balance of capital, that all will be, you will be seeing. Okay, so all these other extra items will be recorded in partner's current capital account, and it won't be recorded here fixed. Okay, whereas here in fluctuating, as you are preparing only one capital account, so all the details will be coming in this particular account only. Okay, right now just remember that in fluctuating, what do you mean by fluctuating? So when there is an increase in decrease in the amount of capital, only one account is prepared. When the amount is fixed for capital, then this fixed capital account will be prepared separately, and a current account capital current capital account will be prepared separately. Okay, see, this is the difference between fixed capital and fluctuating capital. Now, in difference between fixed capital account and fluctuating capital account method. Okay, see, first there is meaning. When the opening balance of the closing and the closing balance of partner's capital account is reported unchanged, it means it is fixed. Okay, whatever is the opening, that is only the closing, there is no fluctuation. Okay, so then it is known as fixed capital. Here in fluctuating, when the opening balance and the closing balance of the partner's capital account is reported flexible, it means there is changes. Okay, there is fluctuation up and down. So under that circumstances, it is treated as a fluctuating capital account method. Next, in fixed, there are two accounts which are prepared. One is capital account and one is current account. Here only one capital account is to be opened. Okay. Next, treatment of transaction. In capital account, capital and changes in capital are recorded. Transactions other than permanent capital are recorded in current account. See, in capital, that is fixed capital, only capital is being recorded, and other transactions, for example, I told you interest on capital, bonus, remuneration, divisible profit, that all are recorded in current account. Okay, as we are preparing two separate accounts. Here only one account is prepared, so everything is recorded in capital account only. That is, all transactions of capital and other than capital are recorded in capital account. Interest on capital. Generally, the amount of capital remains unchanged. Therefore, interest on capital remains constant. Here, as the amount of capital is not changed, so interest on capital is remaining same. Here there is fluctuation in capital, so here the interest on capital amount also keeps on changing because there is fluctuation. Fine. Here, balance of account. Balance of fixed capital account is always a credit balance, while current account, see, you have seen, you'll be seeing this in when you'll be doing the sum, that is fixed capital account will always have credit balance. Whereas when there is current account can have debit or credit balance. Okay. So again I am repeating, capital will be having always credit balance, whereas in current capital account it may be debit, it may be credit also. Here, as only one capital account is to be prepared, it will be always credit. Okay, under this method there can be debit balance of capital account. Okay, here you can see sometimes, but it is very rarely you will be able to see this, that capital account is having debit balance. Next, treatment in balance sheet. Since fixed capital account has credit balance, it will be shown as the capital on liability side. This will be showing the balance on the liability side. If current account has credit balance, it will be shown on capital liability side, and if it is having debit balance, fine, then it will be going to asset side. This is about current account. Fine. current account, credit balance goes to capital liability side, debit balance goes to asset side. Here as only one account is prepared, so credit will go to liability side and debit will go to asset side. Fine. So this is the difference between fixed capital and fluctuating capital. Fine. Further turn the page here. Point number 9. See here what they have given, that is profit and loss appropriation account. See, in final account in 11th standard you have studied final account. Okay, there you have studied 3 accounts, that is trading account, P&L account and balance sheet. Here this is one more account, that is profit and loss appropriation account. To distribute the profit and loss amongst the partners. See, when there is partners, okay, and the things are to be distributed among the partners, then in that case P&L appropriation account is prepared after the preparation of a P&L account in final account of partnership firm. See, last year you have studied that was individual final account. So in individual, that is sole proprietor's final account. So there was no need to prepare P&L appro. Okay, P&L appro account is only prepared when there is a partnership firm. That is, it will be prepared after P&L account. Clear? A separate preparation of this account is not mandatory. It is not compulsory to be prepared separately, but normally we are preparing it. It is a part. See, profit and loss appropriation is a part of P&L account. Okay, it is a part of your P&L account only. The things which are to be recorded on credit side of P&L appropriation account. At the credit side of P&L appropriation account, net profit transferred from P&L account. The profit which was in P&L account will be transferred to credit side. Then interest on drawing done by the partners. Interest on debit balance of current account. This you will understand very nicely when you will do the practical sums. Okay, so on credit side, that is see, suppose this is your P&L appro. Okay, so here there will be net profit which will be transferred from P&L account, then interest on drawing, okay, and interest on current capital debit balance. See how these things are taking place. For example, this is your partner's capital account. Okay, here you are writing drawings, so interest on drawing will be here. Okay, this is your debit side, this is your, see here interest on drawing is debit side, so it will go here on credit side, that is interest on drawing in P&L account. Same way here there will be capital and here there will be interest on capital. So interest on capital is on this side, so here it is on credit side, so in P&L appro it will be on debit side, that is interest on capital. And if there is net loss, it will be transferred here from P&L account. Clear? So this way you will be preparing. And suppose there is current account, so this side interest on current capital, so again it will go here. If your current capital is this side, okay, some current capital have debit balance, some current capital have credit balance, that we have seen in current. Okay, that is when we have discussed about the fixed capital method. Same way when you are calculating interest on current capital, that is on credit side, so this will go here on debit side. Fine. Still, if this is not clear, it will be very clear to you in the next chapter, that is lesson number 2. Now see, debit balance of P&L appro. So this is your debit balance of P&L appro. See, there is net loss, interest on capital and interest on current capital. For credit balance it will be there. So at the debit side of profit and loss appropriation account, net loss transferred from the P&L account, interest on capital account, interest on credit balance of current account. Then if there is any salary, bonus, commission which we were giving here in partners, by salary, by bonus, by commission, so that will also, here it is on credit side in partners capital account, so in P&L appro it will be on debit side. And at the end when you will close this, okay, whatever you get, that is known as divisible profit. See, in trading account you are getting, that is gross profit. In P&L account you are getting net profit. This you have learned last year. Now in P&L appro account, okay, you will be getting divisible profit or divisible loss. Your gross profit or gross loss, net profit, net loss. Here in P&L appro you will be getting divisible profit or divisible loss. Fine. So see, after the deduction of total of debit side of P&L appropriation from the total of the credit side of P&L appropriation, the difference which you are getting will be treated as profit credited to partner's capital account. It means you will be doing the total of a credit side and then you will be deducting the total from debit side whatever you will get the difference here, it will be treated as divisible profit. If this side is greater and this side is having less value, then the difference will come here and it will be treated as divisible loss, which will be distributed among the partners. So see the deductions. After the deductions of the total of credit side of P&L appro from the total of debit side, the difference will be treated as divisible loss, and this will be distributed among the P&L sharing ratio among the partners. Okay, so here if you are getting divisible profit, it will be coming here in partners capital this side. If you are on credit side, you are getting divisible loss, it will be transferred to here. See, as you are going from year to year, from debit to credit and from credit to debit, the same way you will come from appro to partners capital also in the same way. From if you are having here divisible loss, then divisible loss will come here in partners capital account. If you are getting here divisible profit, then divisible profit will be distributed among partner on this side. Okay, so this all will be clear when we will be doing the sums. Fine. So this is your P&L appropriation account. When P&L appropriation account is prepared, so when there is a partnership firm, a separate account after P&L account is to be prepared, which is known as P&L appropriation account. Okay, for giving the effect into the accounts of partners capital. Now here this P&L appro is not compulsory to be prepared, but normally we will be preparing if we are doing this. Okay, so in all the sums, that is in lesson number 2, final account of partnership firm, in all the sums we will be preparing a separate P&L appro account. For lesson number 1, this much theory you have to do. I hope the theory portion for lesson number 1 is clear. Still, if you have any doubts, just be free to ask. Thank you.